Welcome to the Roundup, covering what's important to accountants and advisors across the month of October. This month we'll look at the impact of the gnarly legislation before Parliament, the exposure draft to enact the tax on earnings on superannuation funds with balances above $3 million. But first up, a case before the AAT that has been generating a lot of chatter. This deals with unpaid entitlements and Division 7A. Michael, why the interest in this case?
Yeah, this is a pretty significant case, although it's a little bit too early to say where this is all going to end up. But it's certainly an interesting development on a topic that has been pretty controversial for the last 13 or 14 years. And I guess it's a shame that it's taken this long for this principle, this issue, to really be tested properly. Let's just go back a step. This case, the Bendel case, is all about the issue of whether an unpaid entitlement, so trust distribution entitlement, owed from a trust to a corporate beneficiary can be treated as a loan in its own right for Division 7A purposes. Now, if we go back to before December 2009, the ATO's position, official publicly stated position, was that an unpaid present entitlement was not a loan for Division 7A purposes. A little bit before Christmas, back in 2009, a lot of us were quite shocked when the ATO completely changed that position. The ATO said, look, we've had another think about this. We think these unpaid present entitlements could be treated as loans for Division 7A purposes. And the ATO reached that view based on the expanded definition of loan for Division 7A purposes. Part of that definition says that the provision of financial accommodation is a loan. And the ATO basically said if you have a trust that has appointed income to a company, the company knows that it's entitled to this amount, but doesn't call for immediate payment of that amount, it's effectively letting the trust hang on to that money for its own purposes, and that is a form of financial accommodation. So the ATO said that can be enough for this to be treated as a loan. Now it's a little bit more complex than that because the ATO said for a while anyway that we could potentially use complex sub-trust arrangements to kind of avoid that treatment. But by and large, a lot of practitioners and a lot of clients kind of didn't have the money or the will to fight the ATO on this view, even if they thought it didn't quite sound right. And so went along with basically applying the ATO's new interpretation around that treatment. Now, the ATO has updated its views on that area over the last year or so, but by and large, the main position still remains the same from the ATO's point of view anyway, that these unpaid entitlements could be treated as Division 7A loans. Basically, if you don't deal with them properly, you can end up with a very nasty deemed unfranked dividend issue. Deemed unfranked dividend back to the trust, which could potentially be taxed in the trust at penalty rates or in the hands of beneficiaries, potentially at pretty high rates as well. So this has been an issue that has been around for 13 or 14 years now. It's only now really that this position has been challenged properly through the AAT. And this is the thing, this AAT decision, which has basically caused a lot of interest from practitioners at the moment.
Now, given all of that, what was the outcome of the case before the AAT, and what can we do with that?
Yeah, they're two really good questions. The first one's pretty easy to answer. The AAT found in favour of the taxpayer who had challenged the ATO's views on this issue. So the AAT effectively held that this unpaid entitlement that was owed from the trust to the corporate beneficiary should not be treated as a loan for Division 7A purposes. The complete opposite of what the ATO has been telling us for the last 13 or 14 years. Now, the AAT reached that position a couple of different ways. First of all, the AAT said, well, first of all, it doesn't make a whole lot of sense for these things to be treated as loans for Division 7A purposes because that means that the distribution from the trust to the company can end up being taxed twice in two different taxpayers' hands. And the AAT said that just doesn't really sit very well. Surely that's not what was intended when this legislation was put together. So that's part of it. Potential double taxation of the same thing in two different taxpayers' hands, which would be very unusual. The second thing is that the AAT said, well, if we were to treat these unpaid present entitlements as loans, that would basically make a separate set of provisions in Division 7A, contained in subdivision EA, effectively or largely redundant. And this was one of the things that kind of never quite sat well going back to around 2009 because government had already introduced some provisions after Division 7A was originally enacted to deal with the situation where unpaid present entitlements were owed to a corporate beneficiary, but only where the trust then provided a benefit to shareholders of that company or associates of those shareholders. So there were already a set of provisions that dealt specifically with this idea of unpaid present entitlements and benefits then flowing out to other parties. And the AAT was basically saying that we have to assume that Parliament knew what it was doing when it introduced subdivision EA, and why would they have introduced these provisions if these things were already caught by Division 7A in the first place? Why would those provisions have been needed? And that's a pretty valid argument. Again, it's something that a lot of practitioners were saying when the ATO decided to change its views. Why would Parliament have put those rules in place? They're basically redundant from the moment they're introduced. So the AAT basically said that unpaid present entitlements on their own owed to a corporate beneficiary should not be treated as a loan for Division 7A purposes. And you might be thinking, well, that's huge. That completely changes things when it comes to how we deal with these unpaid entitlements. Well, yes, but this probably isn't the end of the story.
Michael, as expected, the Commissioner has filed an appeal with the Federal Court. What now?
We end up before the Federal Court and we have to see where this plays out. The Federal Court might reach a different conclusion. There's absolutely no guarantee that the Federal Court is going to find for the taxpayer in this case. It may well be that the Federal Court affirms the ATO's view for whatever reason. The other thing to remember here is that in the background, the government has been saying to us for quite some time now that they are planning to rewrite Division 7A, or at least put through some amendments to Division 7A. There's a consultation paper issued by Treasury years ago, and part of that Treasury consultation paper involved basically dealing with unpaid present entitlements owed to corporate beneficiaries as if they were loans, and from an even earlier point in time than what the ATO might do at the moment. So again, there's no guarantee that even if this decision is upheld in the Federal Court, for example, the government won't step in and make a legislative change. Again, all of that is completely unknown at the moment, but this is a very interesting development. This is certainly something to keep our eye on, and Knowledge Shop members out there, this is something we will definitely make sure you're up to date with.
Treasury has released the exposure draft to enact the tax on earnings on superannuation balances above $3 million. Jason, were there any differences between the consultation paper released and the exposure draft legislation?
So throughout the process, the government has stuck strong on total super balance being the measure to calculate any tax under this proposed tax from 1 July 2025. So that is one of the more controversial parts of this measure, because that will include realised gains and also unrealised gains. So there hasn't been a change at a high level on that. There's been a couple of tweaks along the way throughout the consultation process. So looking at the draft legislation, there is a carve out for limited recourse borrowing arrangements. So when we look at TSB being calculated for our contributions, there are certain limited recourse borrowing arrangements that are added back on top of TSB. But for this measure, the government has confirmed in the draft that won't be the case. So no LRBAs to be added back to the TSB, which will give us more of a net figure when we're looking at assets that are subject to loans. Earlier in the consultation process, there were a couple of tweaks as well. So total permanent disability insurance, if a superannuation member receives proceeds from a total and permanent disability insurance policy, those proceeds will be treated as a contribution rather than earnings, which means those proceeds won't be taxed in that initial year when they're received. They will form part of future TSB, so there has been no carve out there on insurance proceeds, despite a bit of industry feedback, but there still is a carve out on structured settlement type payments. So those are the payments that traditionally come from work cover or motor accident insurance. So the bill introduces or proposes to introduce this new section, Section 296. So a lot of you are probably familiar with Division 293, which captures tax on contribution for higher earners. So now we'll have this Division 296, which will collect the tax starting from 1 July 2025. And the tax will be collected, at this stage it's proposed that be collected by release authority. So that release authority will go out to the member and they can choose to pay that themselves or have that money released from superannuation. So members will need to consider liquidity, so whether they have appropriate liquidity outside of super or inside of super to make this payment.
Can you just run us through how these calculations might actually work?
We look at our example, we have George, and George starts the year on 1 July 2025 with total super balance of 5.9 million. At the end of the financial year, George's total super balance is 6 million. We then need to adjust this to take into account his pension payments that he's made throughout the year and also his net contributions. So doing that, we get earnings for George for the purposes of this measure of $175,000. So that's step one. Then for step two, we need to realise that this tax is only to be applied on amounts over 3 mil. So George won't pay this tax on his earnings on the first 3 mil, so we need to adjust for that. So that's a matter of taking his end of year total super balance, so taking the 6 million from the 3 mil and then dividing that by the 3 mil again. So that gives us 50%. So what that means is 50% of George's earnings, so nice round number, relate to the amount that is over the 3 mil. And then we simply multiply the earnings, so multiply that 175,000 by 50% to halve that, and then by 15% to get our tax. So that leaves us in George's example with tax of 13,125 for that year.
Jason, a question we're getting a lot right now from a lot of Knowledge Shop members is there a workaround or a way to protect clients from this additional tax?
That is a great question, and one that we're being asked more and more often from our members now that this proposal has moved from consultation to draft legislation. Unfortunately, I'm not going to be able to give you a magic solution that's going to help every single client. It's really going to come down to considering our clients on a case-by-case basis, and in some cases also looking at their spouses and other family members as well. When thinking about solutions or possible solutions, it can be easier to break clients down into certain segments. So starting with pre-retirees, so considering a pre-retiree couple where perhaps one member of the couple has a large super balance and one not so large, can we contribution split? So can we split some concessional contributions from the spouse with the larger balance to the spouse with the lower balance? That might help over time, a little bit of planning required. When the spouse with the larger balance reaches age 60, are they able to start a transition to retirement income stream and perhaps take 10% of their super out and then recontribute that to their spouse with the lower balance? So that could be some considerations for the pre-retirees. Thinking about perhaps people that have retired or have reached 65, do they also have a spouse with a lower balance? There might be then an opportunity to make larger tax-free withdrawals at 65 and then contribute those to the spouse with the lower balance. So we did have a relaxation of the bring forward rules a few years ago. So the bring forward is available to people right up until 75. So that could give us an option to move around 330,000 across from one spouse to the other every 3 years, as long as we're able to do that before age 75. If contributing isn't an option or we don't have a spouse, are we considering our tax-free threshold as well? So retirees or senior retirees, generally those over 67, will have access to the tax-free threshold plus the seniors rebate. So that will generally give them the ability to earn around 29,000 if they're a member of a couple or 32,000 if they're a single person. And then we also have the 19% tax bracket after that. So have we considered that? There may be the possibility to withdraw some super tax-free, invest that in the client's individual names or their spouse's individual name and take advantage of that tax-free income there. If none of these things are an option or we have both members of a couple that are over 3 mil, then the next step would be to consider structures. So there may be people that we do some analysis and they may decide to leave their money in the super, so that could be one option. Or we could be considering other structures such as trusts and companies. So the key there is to consider who the beneficiaries are. So if we were looking at a trust and all the beneficiaries are in high tax brackets or all our possible beneficiaries are in high tax brackets, then that might not be an ideal solution. Also with companies, while tax could be 25 or 30%, we do need to consider what are the tax rates of the ultimate people that we might push some dividends out to. Insurance bonds as well, I'm sure they're going to be talked about as a possible option. So generally they pay tax at a maximum of 30% as well. They do have, you may see some Australian share-based imputation funds that are boasting that their tax rate is actually 21% or something like that. That is based on the imputation credits, which we do get in the super fund. So we need to do a like-for-like comparison when we're comparing the different structures. As well as tax, there's also going to be the liquidity issue for some people as well. So if we have a large illiquid asset in an SMSF, so that could be a commercial property or a farm, the way the proposal will work is that we will be taxed on unrealised gains. So if that property jumps 10% in a particular year and that member has a balance of over $3 million, they will get an individual tax bill. So that individual tax bill will give them the option to pay that personally or have the amount released from their super fund. The problem that will arise is if the super fund doesn't have enough liquidity to pay the release authority, and then the individual doesn't have the personal cash, then how are they going to pay that tax bill? So that's been a lot of conjecture in that area. I know the SMSF Association and other industry bodies are trying to highlight these liquidity issues to the to Treasury and the government. So, but it is something that we may need to be mindful of. So there is the tax position, which we've discussed some possible alternatives, but in the future, if this was to pass as it stands, some SMSFs might need to consider whether a particular property remains in a super fund or whether that property is moved to another entity for liquidity reasons. But again, a lot of analysis would need to be done, and we'd need to consider any CGT on taking assets out of super. So back to my initial point, we really are going to need to look at this as a case-by-case basis. Because the proposed start date isn't until 2025, we don't advocate that clients make panicked or rushed decisions and start taking large amounts of super out now. It will be a good idea to see where the final legislation lands, and then we can start planning based on the client's individual circumstances.
Legislation before the House of Representatives amends the way that the rules work for non-arm's length expenses in a superannuation fund. If enacted, the rules apply retrospectively from 1 July 2018. Now, the tax treatment of expenses incurred on a non-arm's length basis really depends whether it's a specific or a general expense. A specific expense is one related to a specific asset, such as a rental property, and it might be maintenance costs on that asset. A general expense is everything else. Now, we covered this issue in the June roundup when the consultation paper was released, but there's one question that keeps coming up again and again from accountants on the Knowledge Shop help desk. So, Jason, can accountants in public practice do the accounting work for their own self-managed super fund?
Absolutely, they can. So that could apply to accountants or even lawyers or other professionals. So they can certainly continue to do work for their own fund. What we need to consider is, firstly, are they completing that work in their capacity as a trustee, or are they completing that work in their capacity as a professional? So if we look at some examples, if an accountant wants to prepare their returns at home, lodge them personally and not use any resources of their practice, that's absolutely fine, because a trustee's responsibility is to lodge the tax return. It's where we start to bring in the practice or the resources of the practice or even the people, where we need to start to consider, is that at arm's length? So if we're asking our office to prepare our returns in full, we should be paying a commercial rate for that return, unless we have an office-wide discount policy. So starting point is commercial terms, but if we are offering everybody in our office, so not just the senior people, but everybody in our office is offered a 20% discount on returns, then that is okay. We can get that 20% discount on returns as well. We also get the question around where some of the work is being completed at home in a personal capacity, and then some of it is being completed through the office. So that could be the situation where an accountant does most of the work at home, but then they ask someone in their office to lodge that return through the office tax office portal. And sometimes it's difficult to find an arm's length rate for that, because it's not a service that we traditionally would be offering to our clients. So all I can say is we really need to consider the cost of the employee or the cost of that service. If we were asked to provide a service to an arm's length client that took, for example, 2 hours, then perhaps we should be looking at billing at that rate. The ATO have indicated that in cases like that, they're not necessarily going to drill down to the nth degree on the calculation, but they may be looking at something that can be explained as to how we came up with that. So if it's something you charge your clients on an everyday basis, you should have records of that. Or if it's something that perhaps is a little bit different, then maybe look at the hourly rate of the people that are completing those services.
And that's the roundup for this month. Life in professional practice is always busy. If you need the right answer right now to assist you just to move that work along, help your team get the knowledge and the resources they need when they need them, give the team a call on 1800 800 232. We'd love to show you how we make a difference to thousands of accountants and financial advisors across Australia every single day. Talk to you soon.